To finish up the points on stop losses and the reason you use them, a lot of people ask me, why is it so hard for people to place a stop? My answer is basic: commitment. When you enter a trade, you have decided to enter the trade. You're going to experience being in the market. To come up with a stop loss point, it's a commitment that you could be wrong. Because if the market moves against you, it stops you out. You then have to admit, I made a mistake. Most people will say, the market was wrong, it went too far, it shouldn't have gone that far. Or my stop, I was too close, I knew the stop was too close. I should have had a mental stop. Mental stops are more financially devastating than actual stops are. A stop loss, when I use the word commitment, as you choose to enter the market and you see a trading opportunity, you say, I want to buy the trade, I want to be involved in this trade. You're a part of it then, but by placing a stop loss, if that stop loss is hit, it ends your participation in that trade. Even trailing stops on profitable positions. I've seen people change trailing stops. Get $2,000 made in a bond contract, something. Move your stop to $1,000, protect half your money. If the market starts to move closer to your stop, and I've seen people change the stop loss. Well, I'm going to move the stop down and give the market some room to work. All that does is increase the size of your loss. But most people find it hard because when you elect or choose to participate by buying or selling, it's an ongoing game like trading is. Trading is constantly going on somewhere in the world. You can buy in New York or Chicago and offset in Tokyo. And you choose whether or not to participate. When you put the trade on, you are now a part of the game. You feel different. If you think about it, I've got a trade on in this. And if the trade is up, you're making money, you feel real good. And you're just walking around like a proud peacock. But when you have to place that stop, it means that you have to make a commitment on your part that you could be wrong. I always like to look at entering a trade and say, I think I want to get in somewhere around here. Where am I wrong? What should my stop be? So that the market, number one, doesn't hit it. And number two, it protects me from totally reversing and falling out of bed and really wiping me out. But I try and identify where my stop loss point is first. Because then I know, all right, that's where I'm wrong. Where do I get in? Now what's my risk? Most people have a problem with stops because of the fact that they don't want to admit you're wrong. I'd rather be wrong than early. If I get in a market, everything's lined up, and the market starts to move in my favor, then everything's right with the world. But then all of a sudden it stops going up, when we're using the case of a buy signal. It starts to go sideways. And it just goes back and forth. And I'm ahead 500 a contract. I'm ahead 300 a contract. I'm ahead 600 a contract. I'm ahead 300 a contract. Boredom sets in. Well, I better get out of this and move to something that's moving. But all my work said, there could be a slight consolidation here before it goes higher. And sometimes you take the trade off. But if you put that trade on, you put it on for a reason. You went through your analysis, you put the trade on, you identified your stop loss point where you were wrong, you placed the trade. What tells you to get out of that market? Nothing. All the analysis still points that it's going up, or if you're short, it's going down. And you have your stop in there. And if the market starts to move, this is why I said when I showed that one period of time, where that closed hash mark is on a bar chart. I've mentioned it before to people. Draw a line all the way across. If there's a positive reversal, there's a reason you're buying it. What's the last close point support? What you call close support or close resistance. But the greatest answer I've ever heard, and I wish it could have been mine, Manny Stoller, who's developed the Stoller average range channel bars. or Stark bands. I was kidding with Manny one day, and I asked him, give me a quote, a good quote that I could put in a newsletter or whatever. And he thought for a second, and he said, I've got it. Stops are for those times when the market's wrong, to protect us. When the market's wrong now, not the trader, but when the market's wrong, it should be going up. That Lucent I bought at 37 that's now at 31 should be up. That Lucent I bought still holding at 37. I've got a Lucent chart in there where it looked like it had bottomed and everybody I know was hot and bullish on Lucent. But the market was wrong. I heard traders say that. I heard holders of certain issues say the market's wrong. It's going to come back. I was a broker. I will not, people have asked me, I don't hear you say anything ever negative about brokers. I said, well, brokers are people too. But a broker makes his commission whether you make money or not. Duke and Duke, remember the movie Trading Places? Duke and Duke still get their commissions. But most brokers, they like to see your stops hit. It's another commission in their pocket. If you have your stop too close, you get stopped out, you go back in. Now he's made 2 commissions instead of 1. I was a broker. I have a very good friend, Dennis, who was a broker. And he's a sharp trader too. And he would tell his people, this is the way it is. I'm going to put you in good issues. I'm going to do my best to do the best damn job I can for you. Find low probability or high probability, good reward ratios as position trades. But I'm also going to look at some shorter term trades because I got to make a living too. I have more respect for him as a broker than anybody else. Most brokers don't care. It's your money, as we talked about before. It's your money. You make it work hard for you. But Manny's expression of stop losses for those times when the market is wrong. Not the trader, the market. But let me tell you something. No matter how much you do, how much analysis, everything you do, you're reading the expectation of other traders. The market, you cannot tell me that the market is too high or a market is too low. RSI can go all the way up to 90 and it could go all the way down to 3. I've seen it. But with the range rules, keeping you focused, your stops protecting your ongoing profits in a strong move up. How high is high? The greater fool theory. Well, I'll buy it today and I'll sell it to somebody who's a greater fool tomorrow. There were a lot of people that bought the NASDAQ all the way up before that bubble burst. High is relative. Market price movement is relative to where you bought it, your perception. If you bought something at a certain level, if you bought the stock at 35 and the stock's at 40, you're going to think you're great. Everything's right with the world. Your perception is it's going to go on forever. Get the emotion out of it. Concentrate on bringing stops up. So if there's any bad news that hits it and it stops you out, when markets correct, you will see fewer surprises come into a market when a market is technically what I refer to as solid. If you're in 80-40 range, you're seeing positive reversals and your moving averages are up and it's selling off to 55 and 50 and turning back up. In terms 50 to 55 with your RSI levels, your stop should be somewhere below at least where the last positive was so that you can hold that position. Many times people who used RSI and don't know about positives and negatives see a bearish divergence and are very quick to sell it. If they're learning positives and negatives and bull and bear divergences, first thing you should think of when you see a bearish divergence is it's a little overextended in one direction. It's a little pricey, but it's not too high because all the indication is the trend is still up. You should be then doing your homework to figure out where are the retracements going to come back to? Where could the next positive be? If that next positive is above where your last positive was, you're still in a strong uptrend. If you fall back into top-bottom support, which was in, one of the charts we have in here, our next chart actually, you see the top-bottom support, you see the positive, you see the resistance levels as the market starts up from the lower left side of the chart. You have a support level, you have a resistance level above it. It goes up from point 1 to point 2, tests that resistance, sells off. Then it breaks that resistance line. What was a top before, we're breaking out of. You go up to point 4, you've got another resistance line that developed. But after the rally up to 4, then you come back to that support at the top bottom. What was a previous top becomes a bottom. Some of this is review, but it is so basic that if you learn to look at charts a certain way. If the market gets overextended on the upside and you see a bearish divergence, say, well, where's my next top bottom support? What should it fall back to? Use your stops to protect your profits and stay in trades longer. Because you could be breaking out to new highs, which you thought, most people say, oh, the market was too high already. It was overdone. It's not going any higher. High is relative. High is relative to where it's been and where it has the potential to go. But just one last point on stops. Use them. Don't be afraid to. Just make sure that you're using it as a trailing stop if you're in a position, because if all your analysis says it's still there, you should ride with it. If you're using it as a protective stop, don't be in such a hurry to change it. You could start off with a $500 risk on a trade you think is 3 or 4 to 1. You're going to make $1,500 to $2,000 on. And say, well, I'll leave it at 500. And then as it approaches it, sometimes people change them. Expression, if you're not sure or when in doubt, get out. If you put a position on, you've placed your stop, and all of a sudden you see, I've misread this whole thing. I don't care if I'm $100 to the good in the trade or $100 to the negative on the trade. If I see I'm wrong, that's the time I cancel stops. I want out at market. Something's wrong. The trade doesn't seem right. That it should have gone through this number. We'll get into if you see a positive and it fails to achieve it and you've bought your stop up below it. But all of a sudden you say this positive could be failing. It's failing to achieve that target even intraday. The market's tired. Take a quick profit. Let the market, again, show you. Nobody should have a gun to your head telling you what to buy, where to buy, how many. But through the edge, you already know what to buy, when to buy, where to buy. And the last question is, how many? How many can I afford? What's my stop loss going to be on it? I've talked before, too, about position size. If my rule of thumb is for every $5,000, one trade on a futures contract, because you cover your margin, usually $1,500 to $2,000, and you're not going to overdo your trading. Leverage is great when it works in your favor. It's a killer when it works against you. Nobody says you have to buy 10 at one time. You see a market forming a bottom. You've heard of nibbling, sticking your toe in the water. Getting to this level using the RSI work we've used, you're not just nibbling. You're not just sticking your toe in the water. You're seeing reasons to do what you're doing. Most people just buy and sell on whims or buy and sell based on what the broker offers them. Here's a great trade. I think you ought to be in it. If it's good, scale in and scale out. You don't have to buy 10 contracts at one time. Buy 1 or 2. Move it. You see it's moving. Then diversify. Get into something else. But always, always use stops. And don't change them unless you have a darn good reason to change it. The next chart shows a line, an uptrend line, with a point A and a point B. I'm sorry, it's not the uptrend line, it's the downtrend line. You'll see a market that had been going down for a while. And while it was going down, it respected that downtrend line. Until which point it broke above it, saying that the resistance had been tested on the upside. And then it sold off a little bit. Well, when it rallied from under the line, there where I have pointed out with the arrow, it crossed the line. Most people see the break of a trend line and say that's a breakout. Well, it might be, but you can violate trend lines and come back and test them again. The safer place to buy, the better place to buy, is where it comes back, where it's marked point B. It's retesting what was basically a resistance line. Now I can look at it and say, now, this is on basic bar chart analysis, just drawing trend lines. But when you draw a trend line based on negative reversals, you have negative reversal points, it's usually a stronger downtrend line. Positive reversal points, usually a better uptrend line. But if you didn't even know, RSI, just basic trading, says when it breaks that downtrend line, make sure it's a breakout. Retrace some, then find a place to buy it. So it's safer at point B. The next chart is just the reverse of that, where you had been in an uptrend line, the market had been in a move up and sold off below that line. Broke that line, and then on a rally, went back and tested the underside of it. A lot of times you'll see price action like that when you're seeing a positive reversal, which the market had been showing all along. Then all of a sudden, the positive reversal target was not achieved on the upside. Sold off, broke the line, and came back and retested it. But if we set a positive reversal target and it doesn't achieve that level, and the market continues to close under it, that level should be considered resistance. Now we break a trend line on a bar chart, and we get a rally back to near where that resistance point would be. But if you allow the markets to show you what they're doing, you'll see basic input of breaking trend lines and things. Make sure it's confirmed with your RSI work. The next one is from the course, the basic course with price cycles and how we calculate them. When I said when you see a positive or a negative, or you see a new high or a new low made, you've got to go back and say, what was the last high? What was this low? What are the retracement levels going to be? So this is just for your further review. The price cycles of dividing the range by eighths, you'll have price targets. What's the 50% retracement? The market broke to the upside. All right, made a new high from that low. What's the 50% pullback? So you're preparing yourself for what may be a trading decision for you. If you try and stay one step ahead, and with RSI analysis, you can stay one step ahead. If you already know the range is breaking it to the upside, you figure where should it come back to? If it comes back to that level, what's the RSI going to look like? So you're starting to change the bullish or bearish temperament that you had. If you're slow to change, the market can take off without you. If you see that there's the possibility of a trend change developing, you're more apt to be prepared when it does set itself up. Your next chart was just rate of change and the basic momentum line. The rate of change momentum on the top part, it's referred to as rate of change or simple momentum. We had talked about before. Today's close minus the close a couple days ago or a couple of weeks ago. I like using the bottom chart there because it's simple, and that's one of the calculations in CFG. CFG is momentum 9 plus the SMA 3 value of the RSI 3. So I use the simple rate of change. Your next one is a simple momentum chart. Now with the momentum, and a lot of people fail to realize this even with taking RSI students, momentum tops out before price does. Momentum bottoms out before price. Basic RSI analysis. But the way momentum actually works, and that's why I come up with this chart, and I'd used it before, with point A, B, and C, price is rising, so is momentum. Price continues to rise, around C and D, but momentum falls off. If you think about it like throwing a baseball or hitting a golf ball, that initial surge powers it up to where it's still rising, but at a decreasing rate. Same thing on the downside. Still falling, but at a decreasing rate. But the two things we had talked about in the very first chart, price and momentum, you need to see them both move in the same direction. A lot of people like looking at volume or whatever. I've used RSI so long and simple momentums that you can get a feel for it. Price is rising, but the RSI is not going up. Price is rising, and the momentum rate of change is falling off. But momentum sometimes will go up and stall and go sideways. And then all of a sudden, kick in a positive, and it'll take off again. Somebody said, I thought that market had topped out. That's why I got out. Knowing you've got a positive that rallies into a bearish divergence, the bearish divergence shows you what? That the market is a little overextended in one direction. Good place to take a profit, let it sell off, let the momentum cool off, and then blow through it with another positive. Your next chart, simple momentum, graphed with the zero scale. You see point 1, you rallied to a new high. Point 2, you sold off. Point 3, you went a little negative. That's a good overview of what a good long-term uptrend should be. You'll get dips back to the zero line. Like Chris values that we'll go over, go to a +5 and a -5. And I've seen them in strong uptrends go to a +5 and stay +5 every single day for 3 months. I remember Hogs did it. Sold all the way off from 58 cents down to 37 cents in about 4 months, and every single day it was a -5. Two of the inputs to Chris that we'll get into, 9 and 45 on close, 9 and 45 on RSI. They never went to the plus side. It was either down or side down, which tells you that the overall trend is still down. But this simple momentum chart says you'll get some dips under the zero line and come back up. With the batting average was interesting. Most guys that bat 350 can win a batting title, which takes me to the point of the trader versus the investor. Which one are you? Do you know? A trader comes into the markets with the goal being to buy, sell, take his losses when they come, increase his bottom line. An investor is a trader that starts off with the idea, well, I'm going to buy, I'm going to sell, I'm going to diversify, I'm going to move the money around. But the market in a particular issue, or a couple of his trades, he may have 3 on. 2 of them are moving against him, but he doesn't get out of them. The other one that's moving in his favor is going to now make the money to cover both losses. Look at each trade individually. If you're right, stay with it. If you're wrong, get out of it. Because if you're the investor, as I said, the trader buys and sells, takes his losses along the way. He knows he's not going to bat 500. He knows he's not going to bat 750. An investor starts as a trader, lets the market move against him, moves the stop, changes the stop, cancels the stop, and after a while becomes an investor. Because now he's a major shareholder in that company. That market has moved so far against him that you hear them say, I can't afford to get out. It's got to come back. Well, it's going to turn around here. It's only short-term weakness. I've heard more excuses for not admitting to just saying I'm wrong and go on. When you're able to offset a trade which is not working, it frees you up to put your money at work in a trade that should. So we don't have to be right all the time. If you look at just making money in terms of being right 30% of the time, 3 out of 10 trades. Number one, you got a pretty good batting average if you're a ball player. A 300 hitter is considered a good hitter. He's only right 3 out of 10 times he's getting a hit. If you make 10 trades and lose on 7, lose $1, and you make at least $3 on the other 3 trades. You've gained 9, you've lost 7, you've got 2 in your pocket, and you're in to play another game. You're still in the game. If you have 3 trades that make $1 and 7 trades where you lose $5, you're going back to whatever source you had to get the money to replenish your trading account because you're in the process of wiping yourself out. Approach every single trade as an individual trade, separate from everything else. We're going to go through some things. I'll talk about intermarket analysis, but approach every trade individually. Am I ready to make the trade? Have I made my decision? Do I have my stop? Do I have a target of where it's going? Do I have probability on my side? And once you put the trade on, let it work. But the first time you start to feel it's not right, you go back and check your numbers. Maybe you said, wait a minute, the crude oil, to where I called Tom that day and said, I want to buy crude. Well, hell no, you buy with your own money because of the fact the moving averages were down. They had just gone from up to side up. The rules that we've gone over so far in courses, the range rules, the moving averages, the patterns, the positives, they're there for a reason. Go through them, and when you see that you're wrong, get out quickly. This is why I asked the question about, do you know why you're trading? Do you know the difference between trading and investing? Do you know the difference between trading and making money? Because if you follow your rules will make you money. But as long as you're following your rules and you're making money, focus too on the fact of controlling your emotion to where you don't get so big-headed that the next time you're going to change, well, this rule's not lined up, but it looks good enough to put the trade on. Or I took some profits and the market's corrected. I think it's going to go down. I'll sell it. If the trend is still up, you want to take profits, fine. If you want to sell it, make sure you realize you're going against the trend just to make a trade. You should have a damn good reason to trade it. Ask yourself if you have what it takes. Ask yourself do I understand what I'm doing and why I'm doing it? Focus on your discipline, because your focus will determine your realities. You break a rule, you're going to pay. You follow your rules, you should be fine. Somebody said to me about having a key to the universe. This is one of the keys to the universe, as that attendee said. If you follow your rules, you at least will not get beat up. Now, if you want to make a mistake by changing rules or choosing to ignore a rule by trading it without a stop, that's a choice you're going to make and you're going to end up paying for. But remember, trading's a game. You got to have a game plan like a team has on the field. You have a trading plan. Games have rules. The better you are as a player, the more you know about the game. They go hand in hand. But not only that, the better you learn how to play the game, the more you will enjoy it. Trading to me is not work. Analysis, looking at charts, is not work. If the charts are talking to you and you're following your rules, you can go along and follow and see what you see in the charts. Take your positions. When you're wrong, get out. When you're in a profitable trade, let it run until there's a reason you get out. If you see a bearish divergence and want to take a profit on a long trade, fine. You see a bullish divergence and want to take a profit on a short term or a short position, that's fine. But many times you'll get an acceleration in the direction of the trend before it turns. So you don't want to get out too soon. That's why you use trailing stops. That's why you use that hash mark for the close on where that stop support should be. Trading decisions, one last thing on that too. You can buy, you can sell, you can hold, and you can do nothing. You could say, I'll reverse the position. That's a trade too. Well, if you're long and you want to reverse it to a short, you went from buying to selling. But basically, you buy, hold, sell, with a hold or do nothing. And a decision not to trade is a trading decision. And there's a reason it entered your mind. Maybe you saw you were in a positive, but it didn't achieve the target on the way up. Move your stop up. You were in a short position and negative, went down below the targeted price on the downside, but didn't close up there or down where it was at the negative reversal target. It came up. It means there's buying down there. Take some profits. There's nothing wrong with taking a profits. Many people try and they say they're position traders and are trying to catch the bigger moves. But a lot of them turn around and take small profits and big losses, which is opposite of what you want to be doing. You want to get yourself in a position. There's a mind game that goes on when you're ready to make a trade. What you think, what you see, what you feel versus what the market is showing you. Pitchers and hitters. Pitcher tries to throw the ball to where you can't hit it. But a good batter knows if it's 3 balls, no strikes, that pitcher's going to put it somewhere around the plate. He's got to put 3 of them in there in a row. You're then prepared for it. Prepare yourself for what you're about to do. But you have to ask yourself, do you know what you are? Are you a trader or an investor? And I'm not saying you take a position trader and turn him into a short-term trader. But I'm saying the trader buys and sells, uses stops, uses discipline, has patience, and allows the market to show him what it's going to do. An investor starts off as a trader, but 9 times out of 10 violates all the rules, changes the rules, and turns around and holds on to a position he knew he should have had a stop in, which he either didn't put in or changed. You better have a damn good reason to change a stop. The only time I'll change a stop is if I think I'm wrong, I'll get out of the trade. If I think it's too much in one direction, you've had it to where you bought a trade on Monday, put a position on soybeans, Walmart, whatever, and all of a sudden it just shot straight up in 2 days. And it got very overextended. It's like a lucky trade. I got in, it exploded to the upside, I'll take a quick profit. Or put that stop in and say, well, at least it was in the direction of the trade. And remember that trading is an ongoing game. You decide whether or not you're going to trade. The market doesn't tell you you have to trade. You don't have anybody holding a gun to your head saying, put this trade on, or you're going to miss it. When the numbers and everything else line up and say it's time to go, it's time to go. But if you decide not to do it, coaching baseball, I can give a runner on first base a steal sign. I've got the batter, I'm giving him a bunt sign. Well, if my batter bunts and the guy on first base doesn't steal, chances are I'm going to get both of them out. It's all in the rules of the game. The kids that I'm coaching, it's discipline. I say, here's the way we have to do it. Here's the way we can increase our probability of scoring runs. Here's the way we can increase our probability of keeping them from scoring runs by playing better defensively, which has to do with stops. Stops are your greatest defense. For fiscal reasons and mental reasons and emotional reasons. Stops tell you you're wrong. Fine, I was wrong. Let me look at my charts again. In our next session, which will start on range analysis, we'll see how range can tell us whether we're in that uptrend, downtrend, but also acceleration factors with range, using the range in combination with moving averages to where if something's going to be a dynamic move in one way or the other, we'll be able to see it before it happens.